My name is Erik Johannesson and I'm a faculty member at the Department of Accountancy, Baruch College, City University of New York. This and other talks in this series about equity valuation is joint work with my good friend and colleague Jim Olson, who's currently a faculty member at Hong Kong Poly U. It draws on 10 years of my own research and 10 years plus of his. And my objective with these lectures is to show how various pieces and aspects of accounting-based valuation fit together. So this lecture is on a special topic related to equity valuation. And as the title here indicates, it's about the role of earnings, book value of equity, and dividends in equity valuation. And the concern here is, what is it that we need to understand about earnings, book values, and dividends if we want to engage in equity valuation activities? So I'm going to expand on the most basic of valuation foundations by focusing on financial statement information and the role of three interrelated core items. It's a bottom-up approach to valuation, which begs the question, what do I mean by bottom-up approach? Well, earnings, book value of equity, and dividends, they're bottom line numbers. They represent value creation, value accumulation, and value distribution, respectively. So when you go out and value companies, these items are talked about. They complement each other, and they all play a very different and important role. And just to be sure, of course, cash flows are important as well. But I would argue that they're not as central as what I'll be talking about today. So if you want to become really good at valuation, you cannot proceed without a good understanding of these three items, these three core variables, and how they interact and interrelate with each other. But of course, there's much more to equity valuation than just earnings, book values, and dividends. For example, analyses of sales growth, the evolution of the profit margin, etc. But be that as it may, we have to have some kind of conceptual and practical understanding of how these three pieces fit together, and how they fit together with a fourth important variable, the market's price of the company, or the company's shares. So in total, we really have four important core variables to connect. So the discussion here is from a big picture perspective. And we need the big picture. It's important because we need it to understand what we're doing from a broad point of view in order to appreciate the nitty-gritty details later on. But if you do feel like this sounds too basic, feel absolutely free to skip ahead to the more analytical points in the second half of the lecture. But let me provide some more motivation here. So the following quotes relate to real-world investing philosophy. The first statement here, that's from Peter Lynch, and he's a famous American investor. And he says that investing is in principle easy. Keeping risk at bay, just make sure that you buy your future earnings and the earnings growth cheaply. So you notice here that this particular saying emphasizes earnings and earnings growth. And you also notice that risk is mentioned, but not as centrally. As a quick diagnostic, we can, of course, see how expensive earnings and earnings growth are. We can monitor the price to earnings ratio, either price relative to current realized earnings or relative to future expected earnings. The second statement here, that's from Warren Buffett, and he says that our fund does not distribute dividends. We like to keep things simple. The objective then is to maximize the growth in book value. So you see, here's a shift away from growth in earnings to growth in book value of equity, and we can see that keeping risk stable is yet again mentioned. In the second statement, we get introduced to the book-to-market ratio, or here in the form of market to book. The market value of a company's equity relative to the book value of its equity. And we can, of course, monitor this ratio to check on the fairness of the market's valuation. So the first statement has nothing to say about dividends. The second statement implies that the dividends in some sense are not that important, and that what we try to do is to focus on book value of equity and the growth in book values. The third quote deals with the idea that profitability should be important. So this quote is due to Graham and Dodd, and it goes back a long time. It reads as follows: "Profitable and stable companies deliver growth and returns in the long run." So it's a statement that highlights that companies have to be profitable, and profitability then has to be defined and calculated. So here we have a potential connection between earnings and book values, and maybe also dividends. So now you can ask yourself the following important question. The three statements here, are they fundamentally different, or is it the case that they're really not that different after all? Do they actually reconcile with each other? That's really what the question we're dealing with here is all about. We're trying to connect earnings and dividends and book values of equity. And by extension, we then also have to talk about the earnings to price ratio, and we have to talk about the book to market ratio. And one can reasonably hypothesize that one needs to understand these kinds of statements here before one goes ahead and starts to value a company or buy and sell shares. So in that sense, the quotes we have been discussing here, they do provide some motivation for what we're trying to accomplish. All right, now let's try to be somewhat more precise. We have to formalize things a little bit. So we're going to use the following notation. We have E for earnings, B for book value of owner's equity, and D for dividends. So that's easy enough. And then we also have P for the market value of the company, or the price. And to keep things simple, let's assume that we just have one share outstanding. That simplifies the discussion. So that would imply that E is really earnings per share, and B is really book value per share, D is really dividends per share, and P is really price per share. This one is trickier. So with respect to timing, E is going to denote forward earnings, in other words, expected earnings in the next period. B represents the current book values. Dividends are expected or forward or next period dividends. And the market value is as of today. So what that means is that B and P are as of today, E and D refer to the future. We then have the following ratios that we'll deal with quite a bit. We have the forward earnings yield, we have the book to market ratio, we have the forward dividend yield. So these are just the three accounting numbers that are the focus of this lecture, scaled by price. And if we now shift the focus to valuation, my claim here is that the simplest and most intuitive starting point for valuation is the forward earnings yield, or its inverse, the price to forward earnings ratio. And that leads to the obvious question, why is it that the starting point in valuation is the forward earnings yield? What is the forward earnings yield all about? And we may want to compare this yield to the dividend yield. And perhaps more importantly, we may want to compare it also to the cost of capital, the discount rate. And one can ask, should we expect the forward earnings yield to be smaller, bigger, or equal to the dividend yield? What about the cost of capital? And then there's also the issue of profitability. Questions you can ask yourselves include, does the forward earnings yield relate to profitability? Does it relate to growth? And what about the book to market ratio? And how can we identify and measure these concepts? All right, moving on. There are a few equations that you not only should but must internalize. And the first one here is one of accounting, the clean surplus relation, which many of you have heard about before. It doesn't say anything about price or value, but it does connect earnings, book value of equity, and dividends. The clean surplus relation comes in multiple forms, and we'll see two of them here to the left. The first one, the first version here, shows that one way to think about earnings is that earnings are just the change in book value of equity plus dividends. So this must be true in expectation. Accountants, they sort of sit down and decide on the assets and the liability. That in turn decides on the book value of equity. They have something in the beginning of the period, they have something at the end of the period, and the difference gives you the change in book value. So once you have measured the end of period book value of equity, BT plus 1 here, and you correct for dividends, then you have also, by extension, measured earnings. So from the point of view of accounting, this is just debits equaling credits. And sure, there may be some complications in the background, but in principle, one can almost think about this as being an identity. This is how accounting works. And I would suspect that this is familiar to most of you guys watching this video. But it is worth repeating, and it really has to be internalized. All right. A second version of the clean surplus relation is this one over here. You can think about it this way, that the book value of equity in some sense is updated as time goes by. So you have the beginning balance of equity, and then throughout the year, value is created, and this is captured by earnings. You add earnings, you deduct the dividends, if any, and that gives you the new updated book value of equity closing balance. So, when I learned accounting, I remember being taught that there were all sorts of messy issues, gray areas, if you will, pertaining to earnings and book value of equity, and also to dividends. A lot of fine print, and somewhere along the line, you do have to learn and internalize this kind of fine print, the fine print aspects of accounting. But for our purposes here today, we simply leave these out. We assume a setup in which there are relatively few complexities. So one example of such complexities or fine print aspects would be that dividends in principle, they're not regular cash dividends but net dividends, including any capital transactions like purchases and sales of shares of the company in question. But this is not something we're going to deal with. We're putting it aside for now. We can assume safely that there are no such transaction. And another fine print issue would be that in principle there are all kinds of different earnings. But we're going to assume that the bottom line earnings in the income statement equal the comprehensive earnings here. So this just ensures that the clean surplus relation in expectation will hold. All right, that was a digression. The second concept on this slide concerns the way you can think about profitability, or more precisely, the forward profitability, which means that we take future earnings and we divide by the current book value of equity. So this now has to reconcile with the forward earnings yield and also with the market to book ratio. And what we have here suggests that if you fix the profitability, the forward earnings yield ratio and the market to book ratio, they have to offset each other. And maybe they also correlate negatively. We're going to use this identity in the future, so you might as well put it in the back of your head. It's not very conceptual, contrary to the clean surplus relation. It's a matter of mechanics, and it's always true. All right, if we combine the first two equations, we get a third one. And that's simply the clean surplus relation expressed in terms of profitability and growth. And we have a new variable here, K as in kilometer, which is the payout ratio. So, if you're watching this lecture, chances are that you are familiar with the concept of payout policies. But for those of you who aren't, the payout ratio is just the dividends divided by earnings. In other words, it's the proportion of earnings that gets paid out as dividends. It could be, say, 20, 30%, or it could be 0%, which is quite common. And for cases in which the payout is zero, of course, then 100% of the earnings are being retained. So if K here is the payout ratio, dividends divided by earnings, then you can think about 1 minus K as being the savings rate of the company's earnings. So the share of the earnings that we put into retained earnings. ROET plus 1 is, of course, return on equity, which is a profitability measure, and the savings rate combined with the profitability gives you the growth rate in book value of equity. In other words, basically, what I'm saying here is that profitability will translate into growth in book value of equity, and that this depends upon the extent to which the company in question has a generous payout policy or not. With a more generous payout policy, of course, then the company retains less of earnings, and hence the book value of equity grows less, all else equal. If you fix the payout policy, then growth in book value of equity and profitability are really two sides of the same coin. They're intrinsically connected. I'll talk a lot more about this slightly later. But so far we have said nothing about valuation, but we'll get to that. The focus on this slide is to set the stage and to show that as a matter of mechanics, we can connect earnings, book values, profitability, and dividends via this fundamental accounting equation, the clean surplus relation. But again, it doesn't say anything about valuation, and it doesn't say anything about the market's pricing of the company. Next, we have something that everyone who has taken courses in basic valuation should recognize, because in most such courses, it is stipulated that the starting point in equity valuation is the present value of expected future dividends, PVED. You're supposed to forecast the expected future dividends, and then you discount them to present value using the appropriate discount factor. Then you should end up with something that's fairly close to the market price. But one can note here that this prescription says nothing about earnings, and it says nothing about the book value of equity. And the confusing matter here is that in practice, especially earnings, but also book values, get far, far more attention than the expected dividends. That's just a fact. So the question is, how do we reconcile this? How do we explain this? How do we explain that you learn that value equals the present value of expected dividends, but dividends receive very little attention in practice? And as you might have guessed, given the topic at hand, we have to ask the following question, and it's an important one. Is it the case that the value of a company today depends upon the payout policy? Should payout policies be generous so as to maximize the valuation? If a company doesn't expect to pay any dividends for the next few years, should we view this as a bad indicator? Or is it perhaps a good sign? So let me put it in sharper terms. The question we're really interested in here is the following. Does a generous policy enhance value? And a gut reaction might be that yes, given that we care about the present value of expected dividends, more dividends should be something good. But then one starts to think about growth. And perhaps you would realize that if you have a very generous payout policy, shouldn't that then reduce the growth in the company? In other words, if you keep writing checks to the shareholders, then you can spend less on the business, and then maybe you end up with a lower growth. So another question we have to answer is the following. How do measures of growth depend upon the dividend policy? If growth is an important characteristic, then you might say that the dividend policy should also be important, if these two things connect. So we have to work this question out very carefully here. And this very much ties into the overall objective of this lecture. When you run into these concepts in the context of valuation, earnings, book value, dividends, and here the dividend policy. You need to have something to fall back on, something in the back of your head. This is how the pieces fit together. This is how they relate to the market's price. A standard application of the PVED concept is the so-called Gordon-Williams model, and you can find this model in virtually all basic equity valuation textbooks and classes. The math is very simple. You assume that you have a growth rate in dividends, let's call this growth rate G, and you assume that the value of the company follows PVED. Then, instead of discounting each future dividend one by one, you can do it in one shot, so to speak. You can calculate the present value of all these future expected dividends via geometric series, and that looks like this expression over here. So R denotes the discount rate, and it can be estimated using the CAPM or some other model, but I'm not dealing with it, the quantification of R in this video. Typically it's something like 8 or 10%, but again, I'm not quantifying it here. It's easy to see that we can also restate the right-hand side of this expression as next period's expected dividends times a multiplier. This multiplier would be 1 divided by R minus G. So value is given by next year's expected dividends times a dividend multiplier. And mathematically that would give you the present value of all future dividends, PVED. But here's the thing. We'd very much like to introduce earnings. So what one typically does is to simply express dividends as a function of earnings and the payout ratio. So the payout policy is typically assumed to be fixed. Let's call it K here. And now you can restate Gordon-Williams to arrive at an earnings multiplier, which is simply the payout ratio K divided by R minus G. In its simplest form, if you multiply future expected earnings by this multiplier, you're supposed to get the current market value per PVED. So again, this is just a restatement of the traditional Gordon-Williams model, but it is expressed with a focus on future earnings, not future dividends. All right, if we reshuffle a little bit more, we get the forward earnings yield. The forward earnings divided by price. And remember how I said that this is perhaps the most important ratio for valuation purposes. So the forward earnings yield equals R minus G divided by K. So no new information has been introduced, we have just reshuffled the same variables as before. But we do get an algebraic expression of what explains the forward earnings yield. We have the discount rate, we have the growth, and we have the payout ratio. So for example, if we have a company whose discount rate is 8%, whose growth is 6%, and whose payout ratio is 0.4, then we would get a forward earnings yield of 5%. All right, so one reaction that you might have to all of this is that this is probably not really what people do in practice. It's probably not the case that in practice people try to measure K, try to measure R, try to measure G, try to figure out what the value of the company should be given any earnings expectations, and then they decide whether or not to buy or sell. But one benefit of this exercise is that it gives you the idea that you want growth to be high. Because the higher the growth, the greater the earnings or the dividend multiplier are going to be. So that sounds quite good. But the question is this a solid claim? Should we take it seriously? Well, every person who ever deals with valuation, sooner or later, and it's usually sooner, they start to talk about earnings and earnings growth. And here we have it. It ties into the motivating quote that we had from Peter Lynch. You want to buy earnings growth cheaply. But in some sense, it is an awkward way of dealing with things from the point of view that in reality, it's not going to be the case that the payout ratio K is a constant. And in reality, it's not going to be the case that growth G is a constant that goes from the near term to perpetuity. So what I'm saying is that we have some awkward assumptions built into this model here, and therefore it would seem that we can't take it too seriously. But we did get an algebraic confirmation that the notion of growth is supposed to be good. And furthermore, we actually also seem to get confirmation of the idea that the payout ratio should be generous, and that if the payout is generous, the market price of the company will be higher, all else equal. But as we will see, what I just said just right now can easily be misinterpreted. Now, if it were true that we had constant growth in dividends and we had a reasonable agreement about what these expected dividends will be, and we knew that they came from a fixed payout policy, then the Gordon-Williams formula is really how we would do valuation. So given the assumptions, this approach to valuation makes sense. But as I just said, they are some awkward assumptions, and the idea of rescaling dividends to get to earnings, it's also really not that intuitive, even though it's algebraically correct. So I remember a friend of mine, an accounting major, whose reaction to being introduced to this was something to the effect of, well, I've taken accounting courses for 2 years plus, and I've never ever been told that earnings are simply a rescaling of dividends. It didn't seem intuitive or natural to him. Anyway, another issue that usually comes up relates to high growth stocks. So what if the growth in the foreseeable future is higher than the discount rate? Gordon-Williams can't handle this, and it usually is slightly embarrassing for the professor when students ask, how can I use this model to value a stock like Apple, for example, which is expected to have sales growth in excess of 10%? The bottom line is that even though Gordon-Williams is theoretically correct, given the assumptions many times make it awkward, if not impossible, to apply it in reality. And trying to relax some of these fairly strong assumptions in the Gordon-Williams models gives rise to the following questions. What happens if growth depends on the payout ratio K? If so, how does that affect the earnings yield? Given that we just saw that we have growth in the numerator and K in the denominator. So maybe the earnings yield is in fact a constant, which then would beg the question, what determines this constant? And answering these questions and other questions as well, that would require a less stringent framework with less strong and awkward assumptions, a framework whose focal point is earnings rather than dividends. And sure, we did see on the previous slide that we can express dividends in the form of earnings in Gordon-Williams. But the fact remains that Gordon-Williams starts with dividends and then earnings can be converted to dividends. What we really want is something that starts with earnings, value creation, and then introduces the dividend policy, value distribution. So even though Gordon-Williams may serve as a useful starting point when applying PVED, it is too rigid and rests on too strong assumptions to be practically useful. So the next thing I'll talk about is going to be the most important concept that you run into in this lecture. And it's a very deep concept. It's referred to as the dividend policy irrelevance theorem. It's also referred to as Modigliani and Miller, or simply M&M. And it's always present in valuation textbooks and valuation courses. And it's also very much present in the real world, because many companies, they don't spend that much time figuring out how much they should pay in dividends to achieve an optimal valuation. In fact, I would argue they spend very little time on this issue. Out of the many things a company does, deciding upon the dividend policy so as to optimize valuation is not that relevant. And the gist of the dividend policy relevance theory is as follows. Even though the price P is determined by the present value of dividends. There's really no need to forecast the dividend sequence or the specifics of the dividend policy. The price today is unaffected. So Miller and Modigliani, they came up with this in the early 60s. Later on, they won the Nobel Prize for this theory. And it's very difficult to overrate the importance of the dividend policy irrelevant concept. But there are, of course, also subtleties. For example, the word irrelevance here means exactly what it says, but with a qualifier. It refers to the future dividend policy. The future dividend policy is irrelevant when you try to figure out a company's value, but the past dividend policy will have influenced the value. So if you paid out a lot in dividends in the past, the value of the company will be less, all else equal. So it is kind of remarkable that according to PVED, you should calculate the present value of future dividends, but you don't care about the sequence or the specifics about the dividends. Because all viable sequences, they must give you the same value. That's the idea here. And what it really says, if you read between the lines, is that you really should think about the value creation rather than the value distribution. You should think about the company's ability to generate value, and that is earnings. Companies sell things, they manufacture things, they provide services, and as they do it, they create value. And then, of course, somewhere along the line, if you create value, you have to distribute value. But exactly when you do so, that doesn't make any difference. And effectively, what I'm saying here is that the distribution of value, the dividend policy, is a neutral activity. It's a zero NPV activity. So there's really no need to come up with the specifics, which, at least in my mind, is truly quite remarkable. But it also means, as I've hinted at, that we can shift our attention to earnings, value creation, and away from dividends, value distribution. And we certainly don't have to make any assumption about the dividends growing at a fixed rate, as in the Gordon-Williams model. And if this causes some confusion now, I don't really blame you, because in some sense we have run into something of a paradox. You learn about the Gordon-Williams model, and to implement the Gordon-Williams model, you have to assume that the growth in earnings and dividends is a fixed constant over all future years. So you start out assuming that dividends are growing at a fixed rate, and then later on you're told that the dividend policy does not matter. And then, of course, you might ask, why did I learn about the Gordon-Williams model when the dividend policy is conceptually and in the real world irrelevant? What is the role of Gordon-Williams in light of the dividend policy irrelevance theory? So just to be clear, there are a few caveats. Of course, there may be reasons, secondary reasons or tertiary reasons why a dividend policy may be relevant. So I'm not saying that it's always irrelevant in reality. But what we're trying to do here is just to appreciate that, yes, the DPI has a thrust of truth to it, and it makes economic sense. And above all, it leads to the fact that we do not have to pay attention to the distribution of value. We can instead focus on the creation of value. And then, of course, you can take it one step further and ask yourselves, do you need book values to create value? Do you need assets to create value? And well, yes, typically you do need assets to create value. The stock of value generates flows of new value, which of course then relates to profitability. So now you have a link to profitability in the form of return on equity as well. And lastly, it's important to note that the dividend policy may be irrelevant for value, but it's certainly relevant when it comes to the growth in dividends and also for the growth in earnings. So let's talk a bit about that. Now, we shift our focus to earnings, and to be sure, we're still going to assume that the price of the stock is determined by PVED. But you see from the second statement here that the dividends have a much more subordinated role. We're really interested in the evolution of earnings instead. And our starting point would be the current earnings. And in the absence of dividends, earnings should grow, right? That makes a lot of sense. And the growth rate should be the discount factor in equilibrium. So for example, if you have a company that earns 100 and they don't pay any dividends, and the discount factor is 10%, if you then have to guess how much they're going to earn next year, the starting point has to be 110. In other words, the same earnings as before, but the company reinvested all their earnings, which in turn generated a return of 10%. Book value of equity has grown, and therefore we're going to have more earnings next period. But if the company pays dividends, on the other hand, it's distributing value. That's going to hurt future dividends. And this is captured by the parameter C here, C as in Charlie. And C is of course a positive number. In fact, let me reveal a little secret here. C is actually our old friend, the forward earnings yield. And in a model like this, the forward earnings yield C is constant. So these three statements that we have up here to the left, they comprise a complete model, meaning that any two statements imply the third. The proof of that is not trivial, it's quite sophisticated, but we do end up with model completeness. And I want to stress one thing here to make it crystal clear. C is not a discount factor of any variety. In fact, if you look in the cross-section, C does not correlate with the discount factor at all, not with beta either. The only discount factor that we deal with in this lecture is denoted by R, and we take that as exogenous. All right, so basically what I'm saying here is that current dividends are hurting next period earnings, which makes a lot of sense. And the gut reaction that you might have is that this is bad from a valuation point of view. But keep in mind that we do get the dividends instead of future earnings. So this kind of trade-off. This of course has to be true for whatever dividend policy you might have. You don't have to assume that the payout ratio KT here is constant. So you can think about KT as being determined in a completely arbitrary fashion. It's a very general variable. So it then follows that without knowing anything about what the payout ratio KT is, you're going to end up with the forward earnings yield ratio, the parameter C, being equal to a constant. Future earnings will be lower if you pay out dividends, but so will price P. And the effects will cancel each other out. So the current dividend payout ratio, KT, is relevant to forecast future earnings. But you notice here that you don't have to address the question, what is K1, what is K2, what is K going to be 3 years down the line and the years after that? All the future dividends are irrelevant. Only the current dividends are relevant because of the way in which they influence the next period earnings. After that, it's like a zero-sum game. Do you get the value in the form of dividends, or do you get it in the form of higher future earnings? From a valuation point of view, in this model, it doesn't really matter. So just to hammer things in, ET plus 1, it does not depend upon DT plus 1 or other future dividends. So the company's price is independent then of DT plus 1, DT plus 2, DT plus 3, etc., etc. The dividend sequence doesn't matter. And when you calculate the present value of the dividends through perpetuity, it'll always give you the same thing. And continuing to hammer things in, I want to highlight that C here represents that if you pay dividends, you're foregoing future earnings. So if you have a very small c, then you will forego fairly little in terms of earnings in relation to price. So having that said, even if the company does pay dividends, this has a very small impact upon future earnings, relatively speaking. So basically, you can think about the forward earnings yield C as being less than the discount rate R in expectation. So C is typically something like 5% or so. All right, the first expression above here shows that if we divide both sides by ET, we get an expression for earnings growth. We have R minus KT times C, or equivalently, R minus D divided by P. And we can see here that we have now a connection between earnings growth and the dividend yield. The higher the dividend yield, the lower the earnings growth, which makes intuitive sense. So if we assume that R and C are fixed, then this kind of earnings growth only depends upon the dividend payout ratio. And it's worth pointing out that this earnings growth does not affect the price of the company, nor the earnings yield, per the dividend policy irrelevance concept. And lastly, if KT happens to be a constant, then of course we're going to get back to the Gordon-Williams model. If KT does not depend upon T, then we end up with a Gordon-Williams model. So, what I've been talking about so far on this slide is a more general framework. It's a generalization of the Gordon-Williams model, which does not require that the payout ratio is constant. I also want to point out that this slide shows the simplest earnings dynamic that captures dividend policy irrelevance. But the earnings dynamic could, of course, be expanded to incorporate all sorts of information. For example, related to the forecasting, we could introduce earnings forecast and profit margin forecast. The DPI would still hold. But in this parsimonious setup, only DT and ET are used to forecast ET plus 1. It's sort of a basic minimum that allows me to illustrate the points I want to make, and also to arrive at a first cut replacement of the Gordon-Williams model, which can then be expanded on. So with an earnings-based valuation framework like the one I've been talking about on this slide, we have successfully shifted our focus from dividends to earnings and to addressing the question of what are the implications of dividends for future earnings, instead of what are the implications of earnings for dividends. So that was the payout ratio and dividends in relation to earnings and earnings growth and valuation. What about the book value of equity? I said earlier that it seemed as if the growth in book value should go down if you increase the payout ratio. And we're probably onto something there. I can sharpen my previous assertion to the following. If you increase the payout ratio, you should expect that you have less growth in earnings, like we said, but also less growth in the book value of equity. And at this point, you might ask yourselves, well, if the payout ratio is irrelevant, then isn't growth irrelevant as well? Well, that turns out not to be quite true. And now we get down to something which is very simple and yet somewhat subtle. And it is the fact that growth in book value of equity should relate to the growth in earnings and the growth in dividends in the Gordon-Williams model. So here's my claim. In the long run, in the so-called steady state, if earnings and dividends grow at the same rate, somewhere along the line, it must be the case that the book value of equity also grows at this same rate. So for example, if you have a company whose earnings are growing at 4% and whose dividends are growing at 4%, then it must be the case that somewhere along the line, if this goes on forever, so to speak, the book value of equity also is going to grow at 4%. So we can think about this steady state growth rate equivalence as a benchmark model. And we hence have a benchmark model now with one and only one growth rate, which applies to the triplet earnings, book value of equity, and dividends. In reality and in practice, you will of course never find yourself in this elusive steady state situation. But in principle, you can conceptualize that earnings, book value of equity, and dividends, they grow at the same rate in a steady state. And as a side note, the intuition here can easily be illustrated by basic demographic theory. So if births in a country, if they grow by 4%, and deaths, they grow by 4%, then the population growth must also converge to 4% as well, given enough time. So in our case, growth in earnings would correspond to the growth in births, growth in dividends would correspond to growth in deaths, and the growth in book value of equity would correspond to the population growth. We have inflows, we have outflows, and we have a balance. All right, that was a digression. So in an earlier slide, one of the first slides actually, I said that the clean surplus relation shows that ROE times 1 minus K corresponds to growth in book value of equity. And on the previous slide, we saw that growth in earnings can be expressed as R minus KT times C. Now, with 3 equivalent growth rates, these two expressions must hence be the same. And we therefore get a new expression for ROE. And what the first formula here shows, it illustrates that if you fix the payout ratio K, then profitability and growth are two sides of the same coin. High profitability leads to high growth in the long run if you fix the payout ratio and the discount rate R. So that's something very important. And it also explains why people care about profitability. It's not necessarily so that they care about the cash dividends, but instead that on average you're going to find that profitability gives you growth, which is a very important characteristic of any company. We can also see that the forward earnings yield C and the growth, they connect as well. The more growth you have, the lower the C, if you fix K and the discount factor R. And from the second formula, we see that ROE and C, they also have a negative relationship, all else equal. And what all this implies is that if you and I agree on the payout ratio K, and we agree on the discount rate R for a given company, but if we disagree about growth and ROE, then we also fundamentally disagree about what the steady state forward earnings yield C is. And suppose instead that we try to compare two companies with roughly the same discount factor, roughly the same payout ratio, then the company with the highest growth must have the smaller forward earnings yield C. The two companies are fundamentally different. It may reflect intrinsic profitability, it may reflect accounting conservative, but be that as it may, the two companies are different. All right, just to round this slide off, let me point out that now we have actually connected profitability to the forward earnings yield C, and we have also connected C to growth in earnings, growth in book value of equity, and growth in dividends. So now we can up the complexity a little bit by combining the dividend policy relevance framework with the standard Gordon-Williams valuation model. And as I just said, in the limit, we would have one and the same growth rate for dividends, earnings, and book value of equity. And combining this with the Gordon-Williams model and DPI would mean that the forward earnings yield C turns out to be a weighted average of the discount factor and the dividend yield. And the weights here, they are the book to market ratio. So that now means that we have reconciled the forward earnings yield C also with the discount factor and the forward dividend yield. The thing is, this is not quite obvious. If you do sit down and do some elementary algebra, you're going to find that this is indeed the case. But I leave it up to you to prove that. As a crude approximation, you can say that the forward earnings yield C is probably something like 50-60% of the discount factor R. That's very crude, but in some sense it's sort of in the ballpark, so to speak. So if we plug in some reasonable numbers here, we can see that this rule of thumb works pretty okay. A typical book to market ratio is something like 0.6. The dividend yield ratio in a steady state is perhaps something like 3%. And if you plug these numbers in, you end up with a steady state earnings to price ratio of 0.59 times the discount rate R. There are other insights from sitting down and doing the algebra as well. So the book to market ratio turns out to be less than 1 if and only if the forward earnings yield C is less than the discount rate R. And for most companies, the book to market ratio is less than 1 and the forward earnings yield is lower than the discount rate. It's typically something like 5% or so. So this would be the normal case. And for such cases, if you go back and combine some of the relations that I've showed in this lecture, you get sort of a pecking order rule of thumb that you may want to remember. And that would be that the forward dividend yield ratio is smaller than the forward earnings yield ratio, which in turn is smaller than the discount factor, which in turn is smaller than ROE. I leave it up to you to put together the proof, but it's all there on the previous slides, including the current one. So the dividend yield is typically pretty small. It's often 0, as I've said before. And given a payout ratio K lower than 1, it must then also be true that the dividend yield is lower than the earnings yield, which, again, we said is typically something like 5%. The discount factor R is perhaps something like 8-10% or so. ROE is typically a bit higher still. And circling back to the book to market ratio, there are 3 primary reasons that the book to market ratio typically is less than 1. We have that the company could be very profitable. I just said that ROE and C have a negative relationship on the previous slide. But it could also be that the business has a very high payout ratio. And then number 3, the accounting could be very conservative, which I'll get to in a minute. And the thing is, you can't really distinguish between these 3 forces just by glancing at the numbers. So to tease out the reason for a low book to market ratio through proper financial statement analysis, that could be a worthwhile exercise, if you want to know if you're dealing with a good, solid company or not. So let me elaborate a little bit on what I just said, and let's check on the algebra. So the expression here, that derives from the relations we have seen on previous slides. And you can go back and check whether or not it's true, or you could simply trust me on this one. So book to market would equal the forward earnings yield C divided by ROE. And if you do the algebra, this expression is what you get. So in the context of the book to market ratio, we have 3 primary things that affect it. Number 1, as we can see, there is a direct link between the book to market ratio and profitability. If we view the forward earnings yield C as an exogenous steady state constant, then any increase in ROE will decrease the book to market ratio, just as a matter of mechanics. And this is actually an empirical regularity. Book to market and ROE, they do correlate negatively in the cross-section. All right, number 2 here. If the accounting is very conservative, this would lead to lower book to market ratio as well. So conservative accounting sort of means that you can pay dividends without hurting future earnings too much. And if you have conservative accounting, the damage done to future earnings due to the dividends, it's less than you might think. Much of the real earnings, so to speak, they're in some sense hidden. And this is captured by the ratio of the discount rate R divided by the forward earnings yield C. The greater this ratio, the more conservative the accounting is. And this would drive down the book to market ratio. And then we have number 3. You also have the fact that if you pay dividends, then you're going to drive down the book to market ratio just due to the mechanics of reducing the numerator. If you have a company that starts paying high dividends, then for every dollar that they pay out, of course, the market value is going to go down by $1. And also the book value is going to go down by $1. And if the book to market ratio was already less than 1 prior to this, then the book to market rate is going to go down even further mathematically. It's just a matter of mechanics. So here's an example for you. If we look at a company like IBM, it has a very low book to market ratio indeed. It's something like 0.16. And the question is, of course, does that mean that IBM has a spectacular track record in terms of growth? No, it does not. Not really. The reason is instead that IBM has had conservative accounting and has paid out a lot in dividends in the past. So ROE then becomes really quite high. The book value of equity, the denominator in the ROE calculation, that's quite low. This then would also imply that the book to market is going to be quite low as well. But this really illustrates the point that I tried to make earlier, that just by looking at the book to market ratio, we can't really figure out the reason why it's so low for IBM. We have to dig a little deeper. All right, if you are observant, you may have picked up on something that could seem a little bit peculiar. I said that the forward earnings yield C is constant and unaffected by the payout ratio K. But I also said that the book to market ratio is affected by K. And we also know from this slide that the forward earnings yield C is a function of the book to market ratio. So how would we reconcile this? Well, if you change the payout ratio K, you're going to change the book to market ratio, sure. But you're also going to change the dividend yield. So both of these two components, they do change, but the changes cancel each other out, meaning that the forward earnings yield C, it really remains unaffected by the payout ratio K in a steady state. All right, the concept of a steady state is, of course, a theoretical one. No company is ever truly in a steady state. But even so, the concept is useful when trying to model a company's values, as it does help you to visualize what the company might look like far into the future in expectation. So a steady state condition, it sort of means that nothing much is going on. The company will just continue to grow, and there's nothing good or bad about it. All transactions in some sense are zero NPV, net present value. So you can change the dividend policy in a steady state, and sure, that might affect the steady state growth rate. But as we saw before, this does not mean that it's going to change the forward earnings yield C. What we look at next now is the growth that takes place before the company enters steady state. So if we remove the steady state condition, then growth that affects the forward earnings yield is pretty much guaranteed. And even if we remove the steady state condition, we can still sort of visualize that the company will be in a steady state at some point in the future. So suppose we have to wait, say, 10 years to get to the steady state. Well, then of course we have to worry about what the growth in the near term, the upcoming 10 years will be. I'll call that the near-term growth. And given this setup, we can say that the 10 years down the line, we will have some expected earnings 10 years down the line, and the company is going to be in a steady state 10 years down the line. So that would then mean that at that future point in time, we could use the standard earnings multiple to value the company. So the standard earnings multiple would be the inverse of the forward earnings yield C. And with a fixed payout ratio in a steady state, this would correspond to K divided by R minus G. Assuming that the company does not pay any dividends in the first 10 years, then as a last step, we could just discount this future value back to the present. We divide by 1 plus R taken to the power of 10 in this case. So in other words, the task in a framework like this is really to forecast what the company is going to earn 10 years down the line. And you could take these expected earnings, you capitalize them with the standard earnings multiple and discount them back. Suddenly you're supposed to have the valuation as of today. This is often referred to as the value line model, and it comes sort of fairly close to what people do in practice. So here's an important question. Does this mean that earnings that we have in the near term are irrelevant? No, of course it does not. Whatever earnings we have in the first 10 years in our case, prior to the steady state, they're going to be relevant insofar that ultimately they will influence the earnings we have when we reach the steady state. In other words, the first 10 years pick up on the growth rate before the steady state, and the greater this growth, the greater the value of the stock, because it leads to higher steady state earnings. Now, notice here that this near-term concept of growth, denoted ET plus 1 divided by E1, is entirely different from the steady state growth reflecting the payout ratio alone. In the near term, the company is not in a steady state, and the growth in earnings does not have to equal the growth in book value of equity or in dividends. But once the company enters steady state, of course, here in our case it's 10 years, then we can expect these growth rates to converge. The normalized yearly short-term growth, which is simply ET plus 1 divided by E1 to the power of 1/10. This is typically higher than the discount factor 1 plus R. In other words, in the short term, we would allow for growth that can be substantially higher than the discount factor. And you can contrast this with the Gordon-Williams model, in which you have R minus G in the denominator, and clearly then growth has to be smaller than the discount factor. And of course, you could introduce all sorts of different near-term payout policies too. It doesn't have to be zero, as in our preliminary vanilla case, so to speak. What you have to do then is simply to take the present value of the dividends and add that to the present value of the capitalized steady state earnings. So the steady state earnings, E star here, will be less compared to the scenario in which no dividends were paid out. But we do get dividends instead. And what this points to is that earnings in the future are going to depend upon the dividends in the near term. If the company is expected to pay dividends in the near term, then the steady state earnings E star will be lower, meaning that the so-called terminal value, the value of the company once it enters the steady state, will be lower. But the dividends, of course, they're valuable in their own right. So the current value of the company is obtained by summing the present value of the dividends and the present value of the steady state valuation of the company. A point at which, this is a last thing, a point at which we don't really care about the dividend policy. What this all boils down to is the following punchline, namely that if you want to understand the forward earnings yield C ratio, look at the near-term growth. And this is true regardless of the near-term dividend policy. To round this lecture off, let me return to the motivating quotes I showed in the beginning. So we had Peter Lynch, he was talking about buying earnings and earnings growth cheaply. Warren Buffett talked about growth in book value of equity and the market to book ratio. Graham and Dodd talked about profitability and growth. And I hope that after having watched this lecture, you now have a little better understanding of the fact that these statements are not contradictory. They complement each other. And even though none of them mention PVED or the dividend policy relevance explicitly, they do not contradict these concepts. And in fact, PVED and DPI are necessary to reconcile the three statements. As a final thing, let me expand and elaborate on a few key takeaways from this lecture that I want you to remember. When we talk about earnings and dividends and book value of equity, if you have to pick one of these three variables, valuation centers around earnings. And in fact, one could argue that accounting very much exists to measure earnings. So book values of equity, there's sort of a means to an end here, the measurement of earnings. because we can't really say anything about earnings and we cannot forecast earnings unless we have some understanding of the book values of equity. But it's important to recognize that this is not to say that PVED isn't valid. It's valid, of course it's valid. But given the dividend policy relevance, we can shift our focus to value creation instead of value distribution and make earnings the focal point. So I claimed earlier that the forward earnings yield, which we called C, was perhaps the most central construct for valuation. And as we've seen, the parameter C enters the vast majority of equations in this lecture, which should indicate its importance. So the forward earnings yield, it's really needed to reconcile earnings, book value of equity, dividends, and price, as we have seen. And even though some of what I've been talking about may be hard to grasp at first glance, if you sit down and do the algebra yourself, you will indeed find that the forward earnings yield C is truly central for valuation purposes. So for example, we said that C reflects how much of next period earnings you give up in order to pay dividends today. We said that steady state growth in earnings relate negatively to C, and so does profitability for that matter. We saw that R divided by C can be used to gauge accounting conservatism, etc., etc. And then I also said that the forward earnings yield C, it's really a weighted average of the discount factor and the payout ratio. So that was about C. The next thing to keep in mind is that in a steady state, the growth in earnings, the growth in book value of equity, the growth in dividends, they must converge to one and the same growth rate. And this growth rate is determined by how profitable the company is and how much it pays out in dividends. So growth and profitability are two sides of the same coin if you fix the payout ratio K and the discount rate. And that's also why people like to see profitability. They envision growth in earnings. But if you're not in a steady state, growth is a completely different beast, and it's relevant to talk about. It may very well differ from one accounting construct to another. So the near-term growth, this concept is fundamentally different from what's simply due to the payout ratio. And this is important because the near-term growth, especially the near-term growth in earnings, that would determine the steady-state earnings, which we can capitalize to arrive at the present value of the company. And lastly, just to be clear, I'm not an investor, I'm a professor of accounting. But I do realize that taking everything that I've been talking about in this lecture to practice, that's difficult. So for example, figuring out C, figuring out R, doing all the forecasting, etc., that requires a massive amount of work. And I'm fully aware that in real-world investing, what may seem clean and clear-cut from a theoretical point of view easily becomes super messy. But even though reality is quite messy, or perhaps because reality is really quite messy, it is both important and valuable to know how certain core variables can be expected to relate to each other. And I hope that after having watched this video, some of these relations are a bit clearer to you. Thank you.